Hello, everyone. My name is Enpo2, and I'm the Chief Operating Officer here at My Financial Coach. I'm excited today to introduce our CEO, Bill McDonald, as well as his guest, David Ayer. We have a very interesting topic for you today. So without further ado, let me introduce Bill McDonald.
Thanks, Empo. Yes, I'm Bill McDonald, the CEO of My Financial Coach. And today we're honored to have David Ayer with us today. We've been asked by a number of our clients who are 1099 independent contractors what they can do from a tax standpoint. And of course, we have subject matter experts like David who bring a lot of capabilities to our clients. Many ask, what's the difference between being a W-2 employee or being a 1099? And I know many of you are thinking about taking a position as a W-2, and you're wondering, what are the pros and cons? I can't think of a better expert than David Ayer to bring to the table. He's not only a CPA, but he's also a tax lawyer, and he works with many, many clients on this issue. So today he's going to walk us through a few case studies to show you the economic difference, and then we'll answer a lot of questions at the end. With that, David?
Thanks, Bill. Thanks, Empo. So it's a pleasure to be here today. We're going to go through a couple of examples that I think will be somewhat informative. Obviously, everyone's situation is a little different. So you can just assume that whatever I'm going to illustrate to you, it may just get the thought process started as you start thinking about your own personal situation and how you might be able to benefit from this. So I'm going to go through a case study that I think is somewhat broad enough that hopefully hits on a number of different topics that you would be interested in. So let's go next slide. And just to give you a quick introduction, so I'm the CEO of a CPA firm, Providence CPAs. We have a division named Physician Tax Solutions. Our client base is scattered all over the United States. We have about 70% of our client base that are physicians, what we describe as entrepreneurial physicians. So these are generally physicians who have a little bit of 1099 income, or they have all 1099 income, or they have other investments such as real estate and or business interests, so that they have some level of complexity, and also for the most part business income that we can help advise them on how to what kind of tax planning is available. So we've had a relationship now with My Financial Coach for some time now. My career goes back over 35 years. As a CPA, I went back to law school, have a tax law degree. What our practice focuses on is the proactive tax planning that I think a lot of our higher income, higher net worth clients are lacking from the traditional accounting firm. So we spend a little bit more than half of our year focused on the tax planning piece. And then the rest of the year is on the compliance piece, which is typically what an accounting firm deals with. Quite frankly, how we view a tax return is really the scorecard to tell us how well we're doing the tax planning year after year. So anyway, that's a little bit about us. On the next slide, just want to go through the fact that even though I'm going to talk about some of these in the case study, several of the items that are available under our tax law. Obviously, anything we're describing today is within the four corners of the tax law. Or the regulations or case law that interprets that. None of the recommendations obviously are intended to promote or result in any kind of penalty. I will say that I would not recommend that anyone take the recommendations that we're providing and try to do it yourself unless you are have the counsel of a tax advisor who understands what each of these tax strategies offer. Oftentimes, a lot of accountants aren't trained to do tax planning, so sometimes going to an existing accounting relationship you might have you may get a deer in the headlights look or a glazed look because they may not have heard of these things before. So when you are looking into these, just make sure you're working with somebody who is familiar. Obviously, we would like to have that conversation as well with you if you are interested. On the next slide, I'll talk a little bit about the agenda that we're going to cover. I mentioned it already. I'll go through a couple of basic concepts between W-2 and 1099 in case you haven't or you're not familiar with the difference between the two. And then, like I mentioned earlier, talk about a case study. So let's just jump into some of the basics. Just at a high level, as you may be aware, a W-2 employee derives that name from a form that when you are an employee, you complete and give to your employer. Basically, it just gives them the information they're going to need to run payroll through the year, determine how much payroll tax to withhold, how many exclusions or exemptions you're claiming, and then it gives them the basic information they're going to need to give you a W-2 at the end of the year. As a general rule, when you are employed as an individual, you really have one of two choices. So that is either as a W-2 employee, which I'll talk about perhaps some of the benefits of being a W-2 employee, or a 1099 independent contractor. So 1099 also is the reference to the IRS form that generally you would receive if you were an independent contractor. So there are a series of tests that the IRS looks at, and there's actually a form, it's called SS8, that if you are an employee or contemplating either an employee or an independent contractor as an individual. So I'll make a distinction there that if you're an independent contractor through a business entity, such as an LLC, a professional association, a professional corporation, or a professional limited liability company, then there's a series of tests that the IRS will look at to determine if you have more characteristics as an employee or more characteristics as that would allow you the freedom to be an independent contractor. With that said, in the context of a physician, the payroll tax rules that govern who is a W-2 and who is a 1099, as a general rule, carve out professionals who have licenses or professional licenses to where they can be, they have a broader amount of autonomy to choose whether to be independent contractor or W-2 from the beginning. So they generally aren't subject to the what is described as the 22 tests that the IRS looks at. So that's the general rule. But at the basic level, a W-2 employee is generally going to be a full-time employee. You're going to work exclusively for that employee, or possibly not exclusively if you have the freedom to do locum tenens work. But anyway, generally, an employer is going to have the control over you as an employee, whereas an independent contractor, which again, because of the leniency or the flexibility of the payroll tax rules, you can literally work exclusively, as a 1099, for a single company or hospital, and still be under the control of that individual. But anyway, without going into a lot of more detail, as a general rule, a physician can choose at the beginning to be one or the other. I will say that if you're going to change your role midstream with a relationship, where you're going to say, okay, I want to go from being a W-2 for this employer to being an independent contractor, then some other factors may play into that, i.e., the IRS may ask the question, why are you converting this other than, to save taxes potentially? And you may have some other, regulatory boards such as a Department of Labor or unemployment tax, boards that may, not see that change from W-2 to 1099 as substantive enough for you to or for your employer to get out of paying any kind of unemployment tax. But worst case scenario, they're in no worse of a situation if your state unemployment tax commission still requires the employer or the company in this case to pay unemployment tax on behalf of 1099 independent contractors because they don't think the midstream change has enough substance. I'm going to go through an exception to any of the payroll tax issues here in in a few slides, but just at a very high level, these are the basics behind being a W-2 versus a 1099. Next slide, please. As you may know, obviously as a W-2 employee, you're familiar with the fact that when you get your pay stub, you're going to see that you have certain taxes that have been taken out. Obviously one tax that you're going to have is what is described as the FICA tax. Your half of that is 6.2%. Up to the FICA wage base, so that changes every year. This year it's $160,200, so it jumped up from about 147 or 148,000 last year. So, and that number will probably continue to jump up, year after year. Then you also have the Medicare tax. Your half of that is 1.45%. When I say half, that means that you pay half of both of those taxes. Your employer pays the other half. So total FICA tax is 12.4%. Total Medicare tax is 2.9%. So a total of 15.3% up to the FICA wage base, and then a total of 2.9% of everything above that. When you're an independent contractor, whatever your 1099 income less all of your deductions, now you're going to pay, in essence, a very similar type of tax. It's called a self-employment tax rather than FICA Medicare tax. On the surface, as an independent contractor, you're going to pay both halves, so the employer and the employee half, whereas as a W-2, you're only going to pay the one half. So that may end up being a factor. Later I'll show you a case in the case study where you just have to take that into account to see if there's other reasons why it may be beneficial to be a 1099 versus a W-2. Anyway, if you are an independent contractor without anything else, you then obviously are not going to have income tax withheld, so you're subject to then paying quarterly estimated taxes, which generally are going to be due April, June, September, and in the month of January of the following year. So anyway, those and that's only if you want to avoid having an underpayment tax and interest if you wait later in the year to pay those estimated tax payments, if you don't have other sources of income where you have enough tax being withheld. There are some benefits, obviously, to being a W-2. Obviously, employee benefits is a big factor. So depending on the type of benefits that your employer offer, most of which can be also offered as 1099. So my financial coach has a subject matter expert that has a very attractive benefits package, available for 1099. So don't give up hope if you have a health insurance plan as a W-2 employee, but you wouldn't be offered that as a 1099 because there are some very competitive opportunities out there to be made whole as it relates to that. Other factors that may be available as a W-2 versus or benefits available as a W-2 versus 1099 could be a match, an employer match on a 401k plan. So generally, when you're making that decision, one of two things: you could either monetize all of those benefits and say, okay, these are the benefits that my employer is paying as a W-2. What is the economic value of those? That since they already are paying that amount, that if they just added that to the 1099 or to the amount that they pay you as a 1099, assuming that's the same amount, and then if they would also add back the one half of the FICA and the Medicare tax that you're now saving them if you become a 1099. So if you able to walk away with an economic package that has the same value or dollars as a W-2, then that's an ideal starting point, obviously, because you've got more of an apples and apples. But as I'll show you here in a couple of examples in the case study, you may not need to have it be totally equal for you to still potentially come out ahead as a 1099. So let's talk about some of the basic deductions that you would be entitled to deduct on the next slide. On this slide, as 1099. So as you may be aware, as a W-2, there's very little that you're going to be able to deduct as as an out-of-pocket business expense unless your employer reimburses you for those. And then it depends on how they treat it from a reimbursement standpoint to whether they can deduct it without having, basically that taxed as income to you, or if they can reimburse you for that and end up not having to pay income tax on that. So that's something that you definitely want to look into if your employer does reimburse you, to make sure that ideally you're not having to pay income tax on that benefit. So things that you can't deduct when you're a W-2 employee are vehicle expenses. So as a general rule, you're going to be commuting to and from work, and that is considered a personal expense and non-deductible. But if you're an independent contractor, again, there you may be, and depending on your home office, and whether, and I'll go over the alternative here in a little bit, but if you have a professional entity that is the independent contractor, then you basically are driving from one office to another, your home office being the office of your professional entity, and then your work. So that then opens up the door for maximizing vehicle expenses, other travel expenses that were otherwise incurred for business that your employer otherwise doesn't pay for and you'd have to pay for, could be deductible. If you work longer than 12-day or 12-hour shifts, including your drive to and from, including that time, then you may be eligible for a per diem allowance that the IRS allows you to deduct, or being able to deduct your out-of-pocket expenses, whichever is greater. And then your 1099 income is also up to certain income limits. A huge tax benefit to some people started in the year 2018 with the Taxpayer Reduction Act, but it's called the Qualified Business Income Deduction, which is 20% of your business income. Again, subject to certain phase outs. If you have a specialized or a specific type of service income that you also have, because those are subject to phase outs at a lower level. You can obviously you can deduct contributions to health savings accounts and IRAs. Those are available, quite frankly, whether you have a 1099 or W-2 income, and then it's possible to be able to deduct certain if you have a 1099 and you're employed by a hospital, you can structure them paying down a certain amount of your student loan payment and have that be basically paid down as a tax-free fringe benefit to you. So back in, I believe it was during COVID, but I think it was the year 2020 or 2021, Congress expanded the educational assistance deduction that allowed an employer, certain employers, to be able to deduct up to $5,250 of student loan payments that they paid down on your behalf, and that was considered a deduction to them, but a tax-free benefit to you. Now, for you to do that as an 1099, that you would not be able to deduct that because you're considered to be a controlled party or affiliated group. So you could the only deduction there would be if you have an adult child, 21 years or older, and that you're putting them through college. You could pay their if you had a educational assistance plan set up ideally by a C corporation, then you could deduct up to the $5,250 of their educational expenses, but only if they're no longer a dependent and have reached the age of 21. So those are a couple of the more popular deductions on the and so on the next slide. Again, these are you need to find out or determine if you meet these tests. If you're an individual 1099, if you're a professional entity, providing independent contractor services back to a hospital or a group, then these deductions are a little more straightforward and allowable. So just be careful, just be mindful that if you're just a 1099 independent contractor, basically reporting your income on Schedule C, some of these deductions may not be allowable, but those include the home office, potential moving expenses, your uniform, obviously scrubs that you are out of pocket paying for, any other medical supplies that you buy, attending medical conferences to the extent that those are not reimbursed fully by your employer, and obviously getting any continuing education credits that your employer doesn't already pay for. So those are some of the handful of basic out-of-pocket expenses that most people incur. I'll mention a couple of other low-hanging fruit deductions that may be there available, if you were able to set up the right type of entity structure, which is what I'm, at the end of the day, you'll see is probably the best way to maximize tax savings if you're going to be an independent contractor. But what I'm going to first do on the next slide is just or the next slide is basically, looking at let's look at a case study that, says, okay, I want to really explore this idea of a 1099 and what the benefits are by taking advantage of all the tax deductions that I can. So let's first look at a case study. So I'm going to first detail this out as if it was a W-2 situation, and then we'll modify this to take into account an apples and apples 1099 conversion. So in this example, we have a physician, 40 years old. I'll put him in the context of an ER, emergency room doctor, which is a significant number of the clients we work with. He works full-time, $600,000 a year W-2 salary, hospitalized, a 403B plan with a 4% matching contribution. His wife Jane, and he has 3 children that live as a family in California. He claims a standard deduction on his tax return, not itemized deductions, and he files as a married filing joint. So let's look at what that looks like, on his tax return. Hypothetically, and so I'm assuming this is the year 2022. Obviously, we're in 2023 now, so some of these numbers may change a little bit. But if we looked at his hypothetical tax return for the year, with $600,000 of income, standard deduction of $25,900 for a married filing joint, leaves taxable income of $574,000. Out of that, or from that amount, he's going to owe federal income tax of $148,000. He's going to have 1/2 of his FICA and Medicare tax that's being taken out of his W-2 salary of $21,414. And then because his W-2 is over $250,000, he will be paying the Medicare surtax of 0.9%, which totals about $3,150. So total federal taxes, $173,005. He lives in the state of California, which is proud of their income tax. That adds an extra $48,339. And that means his total tax liability, federal and state combined, is $221,344. So that's basically what he's stuck with. Very little tax planning other than perhaps deciding to get a large mortgage, pay quite a bit in income tax or property tax. Then he might be able to itemize his deductions. So let's look at the next scenario on the next slide, and that is, let's just take into account that he's going to be a 1099, nothing else, just as an individual. What is his tax liability now going to look like? So again, let's just take the same deductions that he's entitled to. Only difference here is he gets to deduct 1/2 of the self-employment tax that he's going to owe, because now he's going to owe basically the full self-employment tax on his $600,000, less his standard deduction. Now he's got taxable income of $556,000. Federal income tax is going to be a little bit lower than it was as a W-2 employee of $142,000. However, he's going to pay a lot more in self-employment tax, which is the equivalent of the FICA and Medicare tax. And then he's going to still owe the Medicare surtax on the net Schedule C income. So again, in this situation, federal and state tax combined, he's now going to pay $226,000. So at first blush, he's going to pay more tax as a 1099, assuming that he was getting no deductions whatsoever for any business-related expenses. So he's going to pay about $5,000 more in tax if you just look at it apples and apples. What I'd now like to contrast with that is, what would it look like if he went to one more step, which is, okay, I'm going to be able to be 1099. And keep in mind that this, a lot of physicians have a full-time job but then they also generate 1099 income on the side, either locum tenens or they have they may be a medical director somewhere, but they derive income on the side that they also can structure as 1099 income. So it's not it's not an all or nothing. You're not either all W-2 or all 1099. But let's just say that Dr. Sample in this case, takes one additional step, and that is he sets up a corporation. So in California, they don't recognize professional entities being limited liability companies. So your option is primarily just being a corporation. But in either case, it's taxed just like an LLC. If you make the election to have it taxed as what's called an S corporation. So that's just an election that you make with the IRS that says that you will have all of your business income reported on a separate tax return. It's an 1120S. At the end of the year, you'll have a net profits number after all of your deductions, including a salary that you pay yourself. And that net income number then flows through to your personal return. And that's where you then would pay income tax, but only at the individual level. So the S corporation does not have an income tax per se. There are some exceptions to other taxable income that it may have, but as a general rule, an S corporation doesn't have an income tax. So let's take the S corporation in this case, but let's add a couple of extra deductions that we may want to look at. Let's say Dr. Sample wants to look at explore maximizing out other types of retirement plans outside of his 401k plan. So he has cash flow available of let's assume $150,000. I'll show you in a couple of slides where a big part of that additional cash flow is going to come from the tax savings that is going to realize under this structure. Let's assume he's got a home office garage deduction that we can come up with $6,000 a year, about $500 a month. That he uses his vehicle for business purposes, that generates about a $15,000 additional deduction. He can rent his home to his corporation. In this situation, if he rents his home for only 14 days under the tax law, rental income of 14 days is not required to be picked up as taxable rental income on your individual return. But yet, if the business with a business purpose rents your home from you for that 14 days, it still counts as a business deduction. So in other words, it's a way to get a $7,000 in this case, a $500 a day, equivalent of you renting a conference room at a nearby hotel. That would be perhaps the value of your home you're rented for a day. Could be more, could be less. And then let's say you put your 3 children on age-specific responsibilities. There's a tax court case that held in favor of the taxpayer where they employed a 7-year-old son in the family business, and it was considered reasonable for that son to receive a $50,000 a year salary. So in this case, let's say that what we're trying to do is just maximize how much they could get paid to where they don't pay any income tax on their W-2. So there's a specific way of doing that via 1099 to them individually, and then pay them a W-2 from the 1099 business. But let's just assume that they each get a W-2 equal to their standard deduction, which between the 3 of them would total about $38,850. And then one other important thing that this S corporation is allowed to do under current California law, and that is they can make an election at the S corporation level to pay the share of state income tax that is attributed to the income coming through that S corporation. So that's a number that we don't yet know until we run the tax calculation, so it's to be determined. But basically what we're doing is we're moving that state income tax deduction from being a potentially an itemized deduction up to the S corporation as a business deduction. And keep in mind that state income taxes plus property taxes, if you itemize your deductions, at least through the year 2025, are capped at $10,000. So even though in that earlier example, Dr. Sample was paying more than his standard deduction in state income tax, he was capped at the $10,000. So in other words, he wouldn't have been able to even itemize that some $1,000 California income tax. So therefore, it was a completely wasted deduction. Whereas in this case, if we make a pass-through election at an S corporation, then we're going to be able to deduct that dollar for dollar, not subject to the $10,000 ceiling, dollar for dollar as a business deduction on his S corporation return. And then one of the other requirements that you have to make or have when you have an S corporation is, and you work for that S corporation, is you need to pay yourself a reasonable salary. So the IRS has guidelines on what that range is. We have software that helps us calculate that based on industry standards and other factors such as other deductions and such. So it's generally it's not a fixed dollar amount. Obviously, zero the IRS considers is not a reasonable salary, but you also don't have to pay yourself 100% of your net income either. So somewhere in between. So let's just assume that after all of the deductions in this situation, reasonable compensation study results in Dr. Sample needing to pay himself about a $200,000 W-2 from his S corporation, of which he's then going to have FICA and Medicare taxes of $24,028. That tax then is a business deduction, or at least depending on how he reports his salary on his tax return, he can at least now deduct the payroll taxes that he's out of pocket as an additional business deduction. So that basically, let's just take those factors. There's dozens of other potential deductions that may be out there. One of the things that a tax planning firm will do is go through the list of other possible deductions with you and identify which ones you might be spending money on to the extent that they have a business purpose. Then and they're documented, then those possibly could add to the list that I provided here. But I think as you'll see, when I just show you what the net bottom line is, assuming the low-hanging fruit deductions that I talked about, that the taxable income is going to be significantly different than it was in the previous example where the individual was a 1099 independent contractor without having a corporation involved. But in this situation, when we run through the numbers, deduct these allowable deductions from the S corporation, lower the self-employment tax that otherwise would have been paid. State and federal tax now drops down to a much more manageable $93,000. And that's down from the $221,000 or $226,000 that we looked at on those previous slides. So it is more than a 50% reduction in taxes. Obviously, the difference between the 221 or the 226 in the previous examples, which obviously that would have been, whatever Dr. Sample had after taxes is what he had to live on. So now that he's not having to pay that extra $120,000 or $130,000 of tax, that money now becomes available for him to fund a retirement plan with, for example. So that the money basically that's a significant amount of what he's putting away for retirement is actually coming from the tax savings that he no longer now has to pay, assuming that he keeps his lifestyle pretty close to what it was before. So when we look at these on the next slide, side by side, it's pretty obvious that, if you have the right opportunity to be 1099 and you set up that as a, with a professional entity, there's quite a bit of tax savings that that you can realize from that. So that basically summarizes the difference between 1099 W-2. Again, you don't have to have 100% 1099. You can have a small amount, and the higher the tax bracket, the more valuable all the deductions that you can come up against that smaller amount of 1099 income. So don't rule it out. If you just have locum tenens income for now, you can shelter some of that or all of that from being subject to income tax.
Now, I did have a few questions that have come in, and David has been kind enough to stay to answer some of these questions. So I'm going to jump right into the Q&A section of this conversation. Now, David, you mentioned earlier that the student loan payments are tax deductible by 1099 contractors. Can you elaborate on that a little? For example, how does it work? I mean, people have probably deducted some of the interest on their student loans themselves before, and maybe some people may have been confused by that a little bit.
Yeah, so we've had the law in place for quite a while. I can't remember when in my career the student loan interest deduction was created, but it's been at least a decade or two. But anyway, that deduction phases out as your income exceeds a certain amount. So, for the most part, once you're no longer a resident, and now you're going to be earning a lot more income as a physician, you're most likely not going to be able to deduct any interest on student loans. Where a student loan payment could be beneficial is that if you have an employer that you're and you're an independent contractor, and quite frankly, this could apply if you're an employee, and that part of your financial arrangement with the employer is that they pay down part of your student loan debt, then not just the interest, but the entire payment that they make, up to currently $5,250 per year, can be paid by them as a business deduction to the employer, but considered tax-free, a tax-free benefit to you as an employee or a 1099. If you don't have that situation and a hospital or a group's not going to pay that down for you, or they're not set up properly to be able to take advantage or to have that type of a plan, which is an educational assistance plan, then the other option is whether or not you can deduct it as an independent contractor from the income you have. Unfortunately, if it's paid on behalf of you as the owner of your business, and ideally you need to have another entity in existence called that's described as a C corporation, not your S corporation, that has an educational assistance plan as a fringe benefit. You or your spouse or your dependent children are not eligible candidates to pay down any student loan debts owed by them. And I'm sorry if I didn't mention minor children, under the age of 21. You can't have an educational assistance plan that benefits any of you or the family members. However, if and when you do have a child, that reaches the age of 21 and you are still, unfortunately paying for their college education, at least you can adopt if you have your child on payroll and they're providing age-specific responsibility or functions for you, it is possible to have an educational assistance plan that does allow you to deduct the $5,250 for them. So just keep in mind that it wouldn't apply, to your own student loan debt or a spouse or minor children, but it could for older children, or if you can structure it as an additional benefit that you get from your employer, that would also work.
Thank you for that clarification, David. I also noticed that earlier on you had mentioned the health savings account as a tax deduction. Is there any other benefit to having that HSA? How much is deductible and what is it used for, perhaps?
Well, the health savings account is often described as the triple threat of saving tax efficient savings. So the reason it's a triple threat is it's a deduction on the front end when you contribute to it. It grows tax-free as long as you eventually use it for medical expenses, and then when you do spend it on medical expenses, it's tax-free. When you spend the money. So it really helps three ways. From a tax standpoint. In 2023, the maximum you can fund a health savings account is either as a single, and again, you have to have an HSA qualified health insurance plan to do this. The individual contribution can be $3,850, or if you have a married or a family plan, it's $7,750, with an additional $1,000 makeup if you're age 55 or older. So those are the limitations. When you are a 1099 independent contractor, you obviously have the choice to fund an HSA just like you would if you were W-2. But as a 1099 independent contractor, and especially if you go that extra step of having a professional entity, you can also have there's a couple of different qualified medical expense reimbursement accounts that your S corporation, or if you have a C corporation, can adopt. That allow you basically to reimburse yourself dollar for dollar for any out-of-pocket medical, dental, vision, anything that otherwise would qualify as an item or as a itemized medical expense. You can have just reimbursed dollar for dollar, tax deductible to the S corporation. So that actually may be a better alternative than the health savings account, especially if you've got a fairly significant amount of medical expenses in your situation, and and you want to get them and you don't have enough money saved up in your HSA to be able to afford all of those.
Thank you. So another question is around reasonable compensation. Now, when you're talking about reasonable compensation, who decides that? Is that the IRS? Is that you? How does that work?
So it's a combination of several things. So this is an emerging topic with the IRS because S corporations have been around for several decades, at least as far back as I can remember. So there's always been a temptation when you own an S corporation to, not pay yourself any more of a salary than you have to. Because why would you want to pay an extra 15.3% in FICA and Medicare tax? So there's been a longstanding practice, of independent contractors or business owners that have S corporations of artificially setting their W-2 salary, at a very low amount. The IRS now, has passed, regulations, and there's now case law that's been building that that reestablish the fact that and the IRS principle is basically that your W-2 compensation has to be reasonable based on the circumstances. So it's different depending on the circumstances, but at the end of the day, the IRS has a range that could be acceptable. Generally, if you're a very high income physician, you're probably the risk of an audit is probably more significant if you try to pay yourself a W-2 salary of less than the FICA wage base, because what you're leaving the door open for the IRS is to come in and collect the 15 point or the extra 12.4% FICA equivalent, up to the FICA wage base. Your risk above that, it drops down to then 2.9% Medicare tax. So somewhere between the FICA wage base and whatever reasonable salary calculation would result in, then you're just weighing, is it worth the risk of an audit that would force you to pay the extra 2.9% Medicare tax if it got challenged and denied. So anyway, there are software programs out there that allow you to factor in all the different situations, industry, specialization, demographics, and to be able to calculate what that range is. And then at least at the end of the day, you've got a very detailed, substantiated report, so that if that ever did get audited, you can present this report as fairly convincing, authority that at least you just didn't guess at what that number needed to be.
So it sounds like this is quite a bit of work that you've described already, and some people are concerned now with the cost of setting up these entities. So generally speaking, what would you say that the cost to set up an S corp and maintain one would look like for a physician that's looking to explore some of these other additional deductions?
So the cost of setting up an entity that then elects to be an S corporation is not a very significant cost. So part of it depends on what the state filing requirements are. Some states are a lot more expensive, like California, than other states like Wyoming. But anyway, if you're a professional entity, generally you're going to need to be a professional entity licensed or set up, licensed in that state that you practice. If you set up LLCs for other reasons, such as owning real estate or other investments, you can pick and choose which state to set up an LLC in. And an LLC, as many of is generally recommended, or just because it has favorable legislation that keeps creditors in general from suing, if they sue you personally, taking the interest in the LLC away from you. If the business or the asset inside of the LLC gets sued, then generally that liability is going to be contained inside of that LLC, unless there's some reason that the individuals members would get sued for something that they did personally. But anyway, the cost of an LLC could range from a few $100s. You can go on LegalZoom, set one up, get an S corporation, but that's where setting up the entity ends, and where the investment in potential tax planning takes over. So where your investment, where the cost is going to obviously be higher, is in how much tax planning makes sense for you to be willing to have somebody help you through. And as a general rule, I like to use, the multiple of, 10 to 25 times is generally, a good rule of thumb that what you're going to invest in to do proactive tax planning is generally, should be generating anywhere from a 10 to a 25 times multiple in what type of taxes you're going to save. So in my opinion, obviously I'm biased, it's one of the best investments somebody can make if you're in a high tax bracket and you otherwise qualify for tax planning. But I would also submit that if you are in the example, John Sample, paying tax on $226,000, and your CPA has not told you about the options of being a S corporation, and being a 1099. That for the most part, you have one of the most expensive accountants, out there, because they're not only costing you whatever you're paying them, but you're also paying potentially an unnecessary tax. So generally, good tax planning should be a very good investment, if you engage in it. It's not cheap. It's generally going to take a lot more time to structure, all the planning that goes into that versus just putting numbers on a tax return, which is relatively inexpensive.
So that brings us kind of to that last question. I mean, you gave an example of W-2 versus 1099. You kind of alluded to it earlier, but there are times where maybe someone is working in one capacity as well as another. When does it make sense to go to you? Does it make sense if there is, for example, some W-2 income, but then the majority is 1099, or does it make more sense when the majority is 1099, but a smaller portion is W-2?
It depends on the situation. A couple of the factors being what is, how much is your W-2 income and what kind of tax bracket is that putting you in? Because if you're only in a 22% federal bracket, and then you have 1099 income, a nominal amount, doing income tax planning, you're going to only be saving 22% from an income tax savings, and the cost of doing a lot of tax planning may not give you the multiple that I was talking about earlier. So that's one factor. The other is, how much 1099 income do you have? And again, that's a factor of how much other income you also have, because if you're in a high tax bracket, i.e. perhaps 37% on your federal return plus state, now it doesn't take a whole lot of 1099 income to make it worthwhile to at least shelter your 1099 income as much as you can, because it's going to be saving you that 37% plus state tax rate. So the marginal return on your investment is going to be much more substantial than if you were in that lower 22% bracket. So it's a sliding scale. I would say in general, if you're in a 32 to 35 plus on up tax bracket, I would say that 1099 income, doing tax planning with 1099 income in the the $40,000 to $50,000 range is probably a good minimum to make it worth your while to try to shelter at least that amount of income plus possibly more. Keep in mind that you're not limited per se to whatever your 1099 income is. You can deduct more expenses than what you have 1099 income, and the reason that may be valuable is that extra loss that you're generating is going to save you tax against the tax you otherwise would be paying on your W-2 income. So there's a sliding scale, but there's a couple of different factors that determine when it makes sense to do that.
Okay. Well, David, I wanted to thank you so much. I'm sure that all of our listeners are very interested in what you have to say.
Congratulations on taking the first step toward mastering your tax strategies as an independent contractor. You've just watched our enlightening webinar that revealed powerful insights and tactics to maximize your earnings. Now, we have an exclusive offer to help you take your tax planning to the next level. Whether you're a seasoned contractor or just starting out, our team of tax experts will provide you with a comprehensive analysis of your unique situation. We will address your specific needs, answer your burning tax questions, and equip you with practical strategies to optimize your tax planning. To seize this incredible opportunity, simply scan the top QR code on your screen or visit our websites to schedule a free 30-minute introductory call with our Client Success Manager. Our seamless scheduling system will guide you through the process of selecting a convenient date and time for your introductory call. Or if you're ready to take the fast track to saving money, scan the bottom QR code to purchase our Strategic Tax Blueprint. With the Strategic Tax Blueprint in your hands, you'll be equipped with the knowledge and confidence to improve your tax planning and minimize your liabilities. Again, thank you all for watching our webinar. Have a great day.